After learning about some vocabulary, now let's start our learning objective 1, which is compute ROI, which is return on investment, and show how changes in sales expenses and asset effects ROI. So let's talk about that. So return on investment is equal to here net operating income divided by average operating assets. So an investment center's performance is often evaluated by using this measure, right? And how we calculate that? That net operating income divided by average operating assets. So average operating assets include cash, account receivable, inventory, plant and equipment, and other productive assets. Whereas net operating income is, we called it earning before interest and taxes. The question arises that why not we are using net income, instead we are using net operating income. So what is the difference between these two? So how we calculate the net income? Let me just make a space here. So from net operating income, we less interest and taxes, we get net income. Since we are learning the responsibility accounting, so what are the interest rate? That is not under the control of management, right? So the investment center are only controlling revenue, cost, and investments, not the interest, right? So we have to pay interest, so we are not evaluating on the basis of interest. And also the taxes. Can you control the taxes? No way. So that's why we are using net operating income, not net income. And how we can calculate the average operating assets? By using, if we are given a 1 year balance sheet, then we can use cash, accounts receivable, inventory, plant and equipment, and other productive assets. But if we are given 2 years data, let me just make a space. So like 2018, 2019, then what we're gonna do, we just gonna find out the average operating assets as average operating assets is equal to beginning operating assets plus ending operating assets divided by 2, which is, in a sense, we can say that operating assets 2018 plus operating assets 2019 divided by 2, right? This is how we calculate the average operating assets. Now the question arises, while calculating the operating assets, for example plant, right, what value we should take? Either we are taking the acquisition cost or the book value. So the most companies, they use the net book value, which is acquisition cost minus accumulated depreciation, right? So with this approach, the ROI mechanically increases over time. How? Because we are dividing net operating income divided by average operating assets. So look at the ratio. If operating assets are decreasing due to depreciation, let me just write it here, right? So overall ratio is gonna be increased, right? So replacing a fully depreciated assets with a new asset will decrease ROI as well. So what I'm trying to say is that the formula is basically net operating income divided by average operating assets, right? So if a new asset is added, for example, we bought a computer as well, so we bought a new equipment. So in that case, the denominator, it rises, which causes ROI to decrease, right? So an alternative to the using net book value is to use the gross cost, or we can say that we just ignore the accumulated depreciation part. So with this ROI approach, the ROI does not grow automatically over time, rather it stays constant. Thus, replacing a fully depreciated asset does not adversely affect ROI. So, for example, you are evaluating the performance or responsibility accounting for investment center, in which you evaluate the manager based on ROI. For example, 2018, 2019, 2020, right? But since due to accumulated depreciation, ROI is increasing, right? And you can say that, oh my God, this manager is, beating the benchmark, or it's, ROI is increasing. He's excellent manager. So what's actually, going through is that the depreciation is going to increase, causing net book value to decrease. So in that case, this denominator is decreased, causing this overall ROI to increase. So why not we use the acquisition cost? We do not use the accumulated depreciation part, and then in that case it stays the same, right? So now we are going to understand the ROI with three different formulas, and we call this DuPont formula. So in that case, the formula is that ROI is equal to margin multiplied by turnover, right? So what do we mean by margin? Margin is equal to net operating income divided by sales, and turnover means sales divided by average operating assets. So if you see that, if we multiply these margin multiplied by turnover, so margin means net operating income divided by sales, and turnover means sales divided by average operating assets. So sales cancel. At the end, we are ended up having the same formula, which is net operating income divided by average operating assets, right? So why we are doing this? So what DuPont have presented, that it says that ROI, that return on investment, it can be calculated by two ways. One, how much you are utilizing sales to generate net operating income, and how much you are utilizing the assets to generate sales, or in other sense, how much you are using the assets efficiently to generate sales, and what portion of the sales belong to net operating income. So by multiplying this, you can really find out that this manager is doing good in selling, or doing good in operating assets, utilization of operating assets efficiency. So here we go. As usual, we are having